Today, folks, the mega bank that is Goldman Sachs is telling you the decade of golden returns are basically over for the S&P 500, but looking for that future intuition coming from CNBC bull Tom Lee is going to give us an insight into what he thinks is going to happen, which I think is just a fascinating conversation on that path to financial independence that damn well one day retire early, and you should join me on that journey. Let's do this together by hitting that subscribe and liking videos like this, because let's read this article. It's very interesting to me. Is basically Goldman Sachs sees annualized returns for the next decade of around 3%, which is insane to come out here and state what the next decade is going to look like, because anyone that's tried it before has been horrifically wrong. But that's down from the 13% we've recently been used to, and they're citing valuations, extreme market concentration, and more regular economic contractions. And I've stated that we are in a new era of this market. The best decade of market history was from 2010 to 2020. I'm glad I got to be a part of that. Earnings were stable, things were predictable, but now we're in this new era of pandemics and interest rates and inflation. Like, the pandemic set into motion something that I think is still going to take a decade for us to get over, because we're basically 5 years into this cycle of like anywhere from 20 to 30% mood swings within the S&P, right? Which is quite extreme when you compare it to, again, the decade before, where we'd likely see maybe 10% corrections at the most. And this only bodes better for you as a shareholder, as an investor, because when we get massive mood swings to the downside, that's where we get rich. The era that allowed me to afford a piece of real estate in Toronto was the pandemic crash, because we came out of that with a vengeance. Anything you bought at the bottom, the first time I ever used my line of credit, I don't recommend using margin or any of that crap, but in the pandemic era, I was like, oh my God, I don't have enough money. I lost my job. I need something, because this is just way too cheap. And we took sure as hell advantage, just like we did through 2022, right? Like just buying up these dips as much as humanly possible when the market is suppressed. That's just how you get rich. It's a psychological game more than it is anything else. But let's listen to what Tom Lee has to say and where he thinks we're going from here. And we're going to talk about market valuations a bit as well, but let's just take a listen.
Who recently raised his target to S&P 6K. Tom, good to have you. I loved your note the other day looking at what S&P revenue has done in the face of declining inflation, and your general point is that real revenue has accelerated, and that kind of explains why equities have been so resilient.
And let's just point out, he's been saying 6,000 for a little bit, and we're literally like 2.5 percentage points away from 6,000 on the S&P. It is not unrealistic in the bull market we're in to hit 6,000, but let's take a listen.
That's right, Carl. As you know, many investors and pundits thought as inflation fell, and it's been cut in half in the last 2 years, that would cause revenue growth not only to hit a wall, but that earnings would stall. But instead, S&P revenue growth is going to be over 5% this quarter. And on a real basis, that's over plus 2%. And that's the strongest. It's really one of the strongest numbers in more than 2 years. And so it is a really high quality earnings season so far. And, close to 80%, or actually more than 80% are beating earnings so far. So it's a good beat season, but it's early.
I really, really want a soft landing, because I just want people to be wrong. I just want people to understand that like past performance doesn't equal future return. I'm kind of cynical that way when I see people betting against the market, betting against people's long-term retirements and goals, and manipulating them into thinking that it's even humanly possible over long periods of time to just be horrifically wrong. So if this is really the first soft landing that we're going to experience, I'm going to, just tout from the ceiling, hey, all that several years or several decades where we've seen interest rates go up and the market crash and all this stuff is kind of coming to an end. But earnings scorecard for Q3 2024, with a 14% of the S&P 500 companies reporting actual results, 79% of the S&P 500 companies have reported a positive earnings per share surprise, and 64% of the S&P 500 companies reported a positive revenue surprise. And what's fascinating with the earnings we've gotten so far that we've discussed is, like, look at Netflix. They crushed it. ASML is one of the few stocks in the chip sector that got devastated on its earnings, even though it beat all analyst expectations. It's just they're lowering guidance slightly, yet the outlook is still insanely bullish, right? So we're getting this from quite a few companies already, which is nice to see. It's not all rosy and perfect, but this week and next week will be a huge defining factor to everything, especially when it comes to inflation and interest rates, because sooner or later, we're going to start seeing cash flows recover, especially in industrials and infrastructure, something utilities, real estate, everything we've been talking about, which has been largely suppressed, which could really, bode better for the broader market if tech starts to get hindered or is overvalued. But again, tech is still posting good numbers here, folks. Can't argue it. It's expensive, but we're posting good numbers.
Right. And how much of it is due to financials? Is any kind of tailwind, although We heard various comments about this. If a Fed tailwind does exist, is it likely to affect other areas of the economy as much as the banks?
Well, in your opening comments, you talked about industrials, and that's something to watch because last week financials reported, and it was, pretty much universally better than expected, and financials are doing really well year to date. True. But the other group that's very sensitive to the Fed cutting would be industrials, and there's a lot of industrial reports this week. It's about a quarter of the S&P, but I'd say it's so far so good. And again, industrials are doing well in the face of an ISM that's kind of been at rock bottom for 2 years now.
Tom, how much would you ascribe the recent momentum to aspects of the election as that draws near?
I'm going to skip the election part. Calm the F down. Trump, Kamala, they're not the ones showing up to your job. Let's not get too divisive here, shall we?
Are you at all worried? There were some comments out of German PPI was down 1.4 year on year, Tom, but there was some ancillary commentary about worries about a reflationary period, largely due to geopolitical events. We mentioned oil coming back a bit today. How worried are you about that?
Well, I think that headline CPI could definitely get affected because oil moves dynamically, and it has an almost immediate effect on headline CPI. And we know transport costs have also spiked recently. Part of it's seasonal, but that affects headline. I think the market's going to be somewhat skeptical that could trigger a sustained reigniting of inflation, but I think the economic data is going to be a little confusing the next couple of months because, the Boeing strike itself is going to affect the jobs report. But I think ultimately the Fed is still on a path towards getting back to neutral. I think that should be the focus, and that means, stocks which have been strong are really still a buy the dip market.
Buy the dip, baby. Buy the damn dip. Now, when it comes to oil, and what's super interesting about this is it did spike dramatically, but again, it's pulled back to a more modest level. At the pumps, we've personally seen the prices go up a bit. Nothing too dramatic yet. Honestly, I still think we're well low enough to be in this kind of, if we stay within this trend line, I think oil companies are profitable. The end consumer isn't spending too much on gas. Inflation's not going to be too out of control. I think the inflationary period is long behind us. I don't think cutting rates is going to increase inflation. Hell, what's going to be an inflationary pressure on the market is if people like I know, we have made a fortune on the market here. I mean, if you bought anywhere from last October, look at how much you're up, like 42% from those lows. I know people buying cars right now. Like the economy is being stimulated off the back of the S&P, which could also balance out some of the negative effects. It's good to have some of this equity growth. I'm very curious to see where we go from here because, again, I think the pandemic era of inflation's behind us. Once we get through the political cycle, which, again, I don't want to get on my soapbox. I'm so tired of everyone having a political opinion. It's super divisive. It's like politics have nothing to do. If you think your future retirement is going to be coming down to a vote on a ballot, you might as well just leave this country now. Like, seriously, Trump's not showing up to your job. Kamala's not showing up to your job. They're not supporting your GDP or growing the economy. It's innovation, people with skills, people providing for their families and communities. So let's just get off our soapbox, do your voting. Let's get the hell over with it so we can move on, shall we, folks? Because there's a lot of paranoia out there, and I can tell because gold continues to hit all-time highs. And I don't know if this is a bellwether for future concerns in the market. Gold's one of the most manipulated commodities, are of the most manipulated sectors, and I'd love to know what's driving up this value, if it's something central banks are kind of communally trying to do, because again, there's infinite amount of gold out there. In my opinion, they found trillion-dollar deposits. It really just comes down to how fast you want to fund it and get it out of the ground, because at $2,700 an ounce, woo, baby, profitability is here. I mean, I worked with dozens of gold mining companies. Profitability for them was anything over 1,300. That was like mostly all-in sustaining costs to get it out of the ground and get it to market. And now at 2,700, baby, like these companies are printing. So I'm curious if it has a lot to do with countries, controllable commodities, stimulating economies. Again, when you see movements like this in commodities, I always feel like there's some underlying manipulation. We know gold has been a manipulated market for a very long time, as much as oil has. Things are changing, though. Who the hell knows? I'll pass that question off to you. Are you still bullish, baby? Are you still buying? I'd love to hear about it in that comment section.